Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Seb Wallace of Triple Point to talk about the Triple Point Venture VCT. Hello Seb, welcome back to the studio. For those who aren't familiar, could you give us some background to Triple Point and your own experience?
Yeah, absolutely. So Triple Point's been going for almost 20 years now, since 2004. We began actually as a VCT house and have since expanded into 5 investment strategies, managing over 3.5 billion in assets overall. And one of those strategies is venture investing, which I'm here to talk to you about today. I joined the team in 2017, along with 2 other guys. We co-founded the venture business at Triple Point, investing in really early stage businesses and seeing that growth, and obviously can tell you a little bit more.
Yeah, so we're here to talk about that VCT.
Yeah.
What does it aim to do for investors?
Yeah, so the Triple Point Venture VCT actually began in 2011 in a separate guise, but the share class, the venture share class, which is its only existing share class today, which we're here to talk about, is focused on early stage venture capital investing. It has £53 million, just over £53 million under management now. And it has 46 companies in the portfolio across 12 sectors, so quite highly diversified relative to per £1 million of AUM, and really sort of early stage in the sense of when we're investing in businesses that typically have less than £1 million of revenue, and our focus is on B2B investing, so investing in companies that are selling to other companies.
Any particular sectors that you're investing in?
We're a generalist, so we look at all sectors. However, we do have emphasis and preference. So one sector that we are particularly interested in, fintech, about a third of the portfolio's there. My background historically is fintech expertise. But we also look at healthcare. The UK, biggest single payer healthcare system in the world, means that we have a lot of talent in that space. And we've increasingly had other areas such as HR tech, we've got stuff there. And we've got investments in areas as well, such as data infrastructure, so sort of the back-end plumbing of technology. So it's quite broad, but 2, 3 or 4 sectors that really sort of shine slightly brighter than the others in terms of total concentration.
And any other particular characteristics that you're looking for in a company? You mentioned quite early stage, typically pre-1 million revenue to start with.
Yeah, so we are focused on B2B technology investing at seed stage predominantly. Well, what is seed stage? That's investing in companies that have, as you said, less than £1 million of revenue in our eyes. We are always looking at B2B technology because B2B has historically exited around 2 times more than consumer businesses. And obviously exits drive returns in venture. And so it's really important for us that we are focusing in the area which has that highest likelihood. And then in terms of the stage, seed, we invest at seed because in the UK over 60% of exits are for a total EV, enterprise value, of less than £50 million. And so if you're coming in at that seed stage, you can have some really great returns from companies that are still within the realm of likely exit range. Of course, we are looking for, as well, outsized success in every company we invest in. But that just enables us to sort of capture some of that value slightly earlier than perhaps some of our VCT peers do.
And investing in that early stage, really, it's all about the management team. What are you looking for in a good management team?
Yeah, I mean, you're totally right. We obviously look at 3 core areas, the management team being the top one, and then the market and the product overall. But in the team, the number one thing is what we call domain expertise, like understanding the space they're in. I mean, the creme de la creme there is you've actually lived the problem that you want to solve. Really good because you have product insight, but also really powerful because you understand your buyer and can sell to your buyer in a very frictionless way. If you don't have that, then we're looking for teams that have done a lot of research and really understand the space, perhaps adjacent to the issue. So they do understand it still. That's by far and away the most important thing, that experience. But obviously it's really important that they do own a substantial amount of the business. So red flags would include things like not having significant equity stakes, because really these founders are in these startups in order to drive equity value for themselves and for investors. And so that for us is something that's a real red flag. But yeah, that team and that expertise, absolutely pivotal.
So Seb, could you give us some examples of recent investments you've made in the VCT?
Yeah, absolutely. I mean, we've made 10 new investments since we last sat down to speak. One investment's Modo. They focus on the battery energy storage sector. They are all doing all data analysis and reporting to do with performance of those assets. Obviously, asset performance is vital for both value, whether you're an infrastructure provider or fund that owns those assets, or whether you are simply a new business that's buying electric vehicles and understanding what the efficiency of those vehicles is and how you can retain residual value. Modo have had really exciting growth since we were first involved in the business. The VCT was first involved. We've grown, the revenue has grown over 200%, and they are looking exceptionally promising. We also have an investment in them from our EIS, which we did last year, and they've grown over 3 times since then as well. So it's been a really exciting story, obviously an emerging sector, and they're at the forefront of that. So, capturing that growth, they've become the default solution for those that need reporting on their battery infrastructure assets. Another really interesting business is AeroCloud systems. AeroCloud focus on mid-size airport operations and the reporting and management of passengers. Really interesting because mid-size airports post-COVID have seen a real boom. As we all know, there's been a boom across all airports, but particularly those mid-size airports. And they've grown over 50% in the first half of this year alone. And another business really interesting, PetsApp. PetsApp are focused on the customer management, so not the pets, but the owners of the pets for veterinary clinics, and all the financial infrastructure around that. So whether that's payment of ongoing insurance, or whether that's subscription pet food that's maybe prescription based. Ultimately, PetsApp provide that wrapper experience for veterinary clinics and a really coherent experience for the owners of pets. They're international now. We invested in them. They were in the UK. They've now expanded to the US, and they are doing it really phenomenally well.
So if we turn to existing holdings in the portfolio, how are they performing? Any particular highlights there? Yeah,
I think it's really interesting because last year I was talking to you about a new investment, Trumpet. It was quite interesting to come back and how are they doing now? I mean, that business we invested in at the beginning of last year, and since we've invested, over the last 12 months, they've had an average monthly growth rate of over 35%. I mean, Trumpet are microsites for sales. Think, rather than a salesperson creating a pitch deck and sending it on, they create an interactive microsite dedicated to the end business that they're trying to sell to, which obviously increases sell-through rate and interactivity and collateral and use of that collateral. And so that's been a really interesting business. Ably, one of our more established holdings, they're now at very robust 8-figure revenues and continuing to grow there. They're focused on API solutions, that back-end plumbing that we were talking about at the beginning. They're really focused there. And Quick Genius, of course, fundamentals have continued to grow. Their fundamentals have actually grown almost 5 times monthly revenue in the last 12 months. So they've been really pushing on. So that's been very promising.
So Seb, besides funding, how do you help these companies succeed? What extra value are you adding?
Yeah, I mean, that's really important because in today's market, it's one of the first questions that founders ask. I mean, Triple Point's been around for almost 20 years, and so we've been able to develop a very deep level of expertise and network across various different sectors. I mean, at its core, first and foremost, we're a founder-led team. I was a founder of a business. I have that experience, and so we're able to lend that into the business. We've had previous people at Triple Point who are now advisors. For example, Alexis Pren, who was the founder of Receipt Bank, now Dext, a phenomenal success story in the UK technology scene. And we obviously lend his experience to the portfolio. We've obviously got Christian Fays and Charlie Dellingpole, both, again, really prominent fintech founders who are involved in our advisory committee, helping our portfolio companies. And we also offer mental health support to our companies. We have that on call. I mean, it's really hard life being a founder, and it's really important that they're feeling on tip-top game. And so those are some of the ways that we help. We also have a whole plethora of discounts that we offer our portfolios, whether that's for Slack or something similar to that, all the way through to AWS credits. In fact, we used to partner with AWS, or did partner with AWS in a London-based Kickstart fund, and alongside the Evening Standard 3 years ago. And so we continue that, and we offer benefits to our portfolios in that regard with some of those technology businesses that sort of are typical providers of the early stage companies, and therefore a typical significant portion of the cost base. So that sort of cost base support combined with expertise, people who've been there, done that, and are able to offer their advice every now and then when needed, are the core ways that we help our portfolio.
So changing topics slightly and turning to the current economic environment, see higher interest rates, higher inflation, is that affecting the way that you invest at all?
Yeah, I think that's a really interesting question, because interest rates going up does change the way things work. Now, in the very early stage where we are, seed stage, there is a lack of correlation between, or at least lack of clear correlation between the public markets and what we're investing in terms of values, in terms of growth metrics and multiples. But what is definitely clear is that the market writ large are much more pensive, much more thoughtful in the way that money's being deployed. And that means for us that valuations are perhaps coming down slightly, which is obviously great for new investors coming in, great for us, great for the portfolio's average weighted valuation on entry. But it also means that those founders are, because of that perhaps increased friction in raising, they're having to learn the sharp end of business much earlier. It's not just about grow the products and growth at all costs. It's also do it in a way that your cost base is sustainable. And I think that's healthy and is promising for that generation of startups who, 10 years from now will be the winners in the market, or 15 years now will be the winners. And if they've learned the best way to do things from day one, then that's only a good thing. And over the last 3 or 4 years, naturally, the outliers have always done very well, but there has been perhaps a delay in the requirement to have to learn that efficiency. And I think it's just being rammed home now as something that you have to do straight away. I think this is a really positive thing overall. In our stage, we've actually seen comparable levels of investing in terms of total quantum invested in the UK to what we've seen in historic years. But just the pencil's a bit sharper in terms of the valuation, and more importantly, internally at the businesses, how they're running themselves. I think that's only a positive thing midterm.
So more discipline from investors, more discipline from entrepreneurs. Feels positive.
I think that's a great summary, yeah.
So turning to opportunities, where are you seeing the most interesting opportunities at present?
Yeah, I mean, there is a saying that global tech has gone through its recession in the last year and a half, whereas the rest of the public markets is like, is there going to be a recession? In tech, there definitely has already been that recession. I mean, viewers at home will have seen the mass layoffs that went on at the top tech companies. Now, actually, that for us is a great thing. When good talent, experienced talent, leaves a large, safe job, it increases, unsurprisingly, the number of interesting new companies that are being started, where people say, well, actually, I've got my time to think, I've got my severance package, I'm going to start my new business now. And in 2008-9, we saw some of the most phenomenal successes today, whether that's Slack or Uber, all the way through to businesses back in 2001, like PayPal. These businesses started in difficult times. And actually, we're in that potential time in technology. Now, it hasn't necessarily translated through to the whole economy as a recession, but in tech, the big tech in particular, there has been that recession. And that's leading to many more interesting opportunities at the stage we invest. And I wouldn't say in particular there's a sector per se that is interesting, but I do think that the overall caliber of founders that we're seeing now in the last 6 to 8 months has increased, and may it continue, hopefully.
And I guess with the tech layoffs in large companies, if I asked you a few years ago what the biggest challenges were, one of them would have been access to talent. And
exactly. You get poaching.
Exactly. Less so. There's less pressure on talent.
Yeah, exactly. And although wages haven't driven down, I mean, we all know wages have gone up, the availability of the talent just means that there are more options, so you get perhaps better value for that money you would be spending. Exactly. So I think it's a good thing.
So what are the biggest challenges you face today as an investor and as an entrepreneur as well, I guess?
Yeah, I think it's an interesting market because there is this recalibration going on in values overall in the market, what people should be paying for their equity stakes in businesses. it can become difficult for a founder to know when to raise and how much to raise. And obviously a good investor by your side can help you with that. But there is undoubtedly be difficulty. In the first half of this year, deal flow volumes were down and across the board. And I think that, and they're starting to pick up again now, but I think that part of that uncertainty, was good. It meant that people had to trim their workforces and sort of find efficiencies. But that's definitely a difficulty. I also think that if you look writ large at the economy and software, which is what we invest in, software drives efficiency. So when there is a time of economic uncertainty, software can be a great solution for big businesses who need to cut their cost base. But sometimes it can mean that those software products sell slightly slower. That's a risk. It hasn't fully translated through yet, but it's obviously something that we're very careful of. We're watching because that can affect growth rates. As of yet, the first of those two outcomes is the one we're seeing more, which is, okay, I'm going to cut my workforce, trim my workforce, and I'm going to try where I can to supplement with technology, to just leverage the people that are there. But we obviously make sure that we're thinking about the second thing, and obviously fundraising is now a slightly more uncertain environment than it was for a founder 2 years ago.
So what are the risks for investors? Say for every 10 companies that you back, how many are you expecting to fail? How many would make it?
Yeah, so we model expecting about 50% of the portfolio to fail. Now, we're not quite there yet in terms of the portfolio failure rate. In fact, our absolute failure rate is under 10%. It was just over 5%. We expect that to grow, but also we would hope that there's a power law distribution as well. So the companies that are doing well are doing exceptionally well. And with this difficulties in the funding market, as I've explained, which is actually quite a good thing for an investor, but for a founder, it's quite difficult. It means there's a concentration of flight to quality. And so that can mean the businesses that are doing well really raise a lot of money and really grow their valuations and their momentum. But the businesses that perhaps aren't doing as well, they fall at the wayside more quickly. Now, we haven't yet seen that in the portfolio, but on paper, that's what we would expect, and it's what we model. Yeah. And that's probably, the risk is that you want that to play out. And to date, it's played out to the upside for us versus our modeling. But it's obviously something we're always being very careful of and watching.
And so turning to exits, any recent exits in the portfolio? What's the outlook for exits looking like?
Obviously, yeah.
Tough funding environment, but exit environment, I imagine, is
pretty
tough.
It's really interesting because, like being an investor where the entry environment for your sort of equity stakes have dropped, it's a great time to be a buyer of software businesses. That is a positive and a negative thing. Overall, though, I would say that there have been fewer exits in the market writ large. In fact, just a couple of days ago, Bohurst released their exits in the UK report, which confirmed that. We have had a couple of exits. We've had this portfolio now total for just over 5 years. We've had 2 exits already. Obviously, last year we had Credit Kudos, which was $150 million sold to Apple after 2 years of investing. So very healthy IRR there. And we had Adepto before. Our strategy, though, doesn't expect exits that early. Obviously, we're always looking for exits. That's great. That's the way you drive value. But investing at seed stage, we're typically looking at 7 to 10 year hold periods per company. So maybe a year or 2 more than perhaps our Series A VCT peers. And for that reason, we would be expecting the first exits, of which we've already had, but the first exit's probably 2 or 3 years from now. Yeah. So right now, what we've had, we're positive about. The market overall, though, really quite interesting as to what it means for exits and their values in the year or 2 to come.
And the turning to performance of the VCT, how's the VCT performing recently? Yeah.
I mean, so we are, total return since 3.5 years ago is about 20%, just shy of 20%. So that's really good. We've even though we're a relatively new VCT, we're not new anymore, but we've been around. This is our 6th year of fundraising. We've delivered 11p of dividends, and we are seeking to increase that dividend yield up to 5p a year, provided there are distributable reserves available to do that. And so overall, I would say that in what's been quite a difficult year for the market, we're actually sitting relatively positively. And there's some really interesting stories, as I mentioned, in the portfolio that will hopefully lead to some interesting uplifts in the next year or maybe 2 or 3.
And you mentioned dividends there. What are you targeting in terms of dividends, and are you confident you can achieve it? Because I guess for your portfolio, you need exits to happen to start generating those dividends.
Yeah, it's interesting because the VCT was started in 2011, we have distributable reserves from other share classes that we're able to use to deliver effectively cash back to investors in the meantime. We have, as I said, issued 11p of dividends back to shareholders. But you're absolutely right. Like the core of the long-term distributions has to come from exits. We are seeking up to 5p per year as our target. We've done 3p a year historically since inception. This year we've just announced a 2p dividend in the summer, and we'll keep that under monitoring over the next six months or so as to what we do next. But we certainly would like to increase that dividend yield as much as is possible within that realm of distributable reserves.
So Seb, to sum up, I would like to invest in a VCT this year. Why should I invest in the Triple Point Venture VCT?
Yeah, really good question. Triple Point's VCT, it's a younger VCT, it's nimble because of that. We're seeking, obviously, dividend and capital growth. We're focused on the seed stage, which is slightly earlier stage than many of our VCT peers. Enables us to capture a bit more of that value early. And we have a very diversified portfolio as well, giving you exposure to a plethora of sectors relative to every £1 million of AUM we have. So I think we're a really good complement to some of the bigger players in the market that you may have invested in before.
Seb Wallace of Triple Point Ventures, thank you very much.
Thanks, John.
If you are watching on YouTube, please press like and subscribe to the channel for more.